specialized investment funds, SIFs, wherein your minimum threshold is 10 lakhs. So it kind of ensures that mass retail is not really the target for this kind of product.
What's one market indicator you check before entering?
I like to look at is the face of one of my portfolio managers. Because that for me is a one integrated snapshot which covers, you can make out from the expressions whether is it a good day for the markets given our positioning and the way we are positioned for it, or is it going to be a horrible day.
Okay, what one investment tool which you have never broken?
I think I've broken all of them.
So Shriram, my first question to you is with investors who are now just getting familiar with specialized investment funds, SIFs as we call it. Okay. One, how is it different from assets like PMS or AIFs or mutual funds? And could you tell us more about specialized investment funds?
Sure. Thanks for having me, Nilesh, on this podcast. Overall, I think if we go into, let's say, from a regulator's perspective, SEBI, I think through 2021-22 period is where I think a couple of things were coming out. One is that mutual funds, given the regulatory regulations that were prevalent and all the changes that had happened in various things, the level of risk appetite in those funds was relatively constrained. And those had to be done given various things that had happened before that. And on the other hand, you had, of course, AIFs, PMS, which had a lot of leeway in terms of product innovation, offering, etc. But where the regulatory oversight was much lower than what was there in mutual funds. So I think what SEBI wanted to do, I think, and which was the whole idea, that come out of the category which has the mutual fund kind of oversight, but has more freedom, more risk bands in a way, to be able to come up with more product innovation, to be able to cater to the needs of investors who are looking at slightly more different, riskier products maybe. But at the same time, ensure that it is not for mass retail, right? That's where SEBI wanted to make sure that people who don't necessarily understand product complexities and all that should not be missold a complicated product. So with all this in mind, I think the solution that they hit upon, which is I think extremely positive and amazing that the regulator came out with it as quickly as they did, was specialized investment funds, SIFs, wherein your minimum threshold is 10 lakhs. So it kind of ensures that mass retail is not really the target for this kind of a product. The regulatory freedom is a lot more compared to mutual funds on various parameters, whether it's in terms of, let's say, shorting abilities, derivative usage, the kind of strategies that you can offer, sectoral issuer limits. All of these things have been given more elbow room compared to mutual funds. But at the same time, finally, the whole regulatory oversight that one is accustomed to having from mutual funds is as much applicable to SIFs. And that's where the meeting of the two worlds really happens through SIFs. And I think we are still in the early days. It's been now maybe 6 to 8 months since really things have taken off for a lot of SIFs. But I think we're going to see this category really become more and more significant in terms of from an investor's choice perspective.
So, there are three categories, which the regulator has mandated. Could you elaborate a little more on these three categories? What are they? What are the risk factors?
Right. So basically under SIF, so I think SEBI has adopted a fairly clean structure, I would say. So you have three broad categories. You have equity, you have debt, and you have hybrid. So similar to how one is used to on the mutual fund side, that's how they've categorized it. Within that also they have given clearly the subcategories and the do's and don'ts within each subcategory. So for example, in equity category, you have three subcategories of SIFs, whether the equity long short, the equity X top 100 long short, or the sector rotation, for example. These are the three subcategories within equities. Obviously, the overarching regulation over here is that equities needs to be beyond the threshold that is required to qualify for the equity bucket. On the other side of the spectrum, you have the debt SIF category, wherein there are two subcategories. One is the debt long short, and the other one is the sectoral debt long short. And the third category that you have is a hybrid category, where basically it means that both equity and debt have to be between 25 to 75% of the overall fund. So neither of them can exceed 75%, neither of them can be below 25% either, and that's what makes them hybrid. Within this, you have two categories, again, subcategories. One is the hybrid long short, SIF, and the second one is the asset allocator hybrid fund. So these are the two subcategories under hybrid. So those are the three broad categories. Within that, you have about 7 subcategories that are available. Where we are seeing maximum action right now is in the hybrid category, and within that specifically the hybrid long short, simply because that's one of the more versatile categories to be able to offer differentiated products, and which is where across the industry various players have come up with different types of thought process, but they're all using the same hybrid long short SIF category, but they have their own nuances to the way they are positioning. We're now gradually seeing more action happen in the equity subcomponent as well, the plain equity long short, the equity X100, etc. Where we might not see too much action happen, maybe, and it's something we'll see how it goes, is on the debt SIF side. Because over there, one is of course the marginal taxation still prevails for products under the pure debt SIF categories, the two categories that are there. And the second thing is the freedom that one has compared to regular mutual funds. While it is there, it is still somewhat marginal. So I'm sure the regulator is also keeping an eye out on how things happen over there, and maybe keep assessing if how it can be made more lucrative from an investor's positioning. But right now, our sense is hybrid category and the equity category are where bulk of the action is likely to happen, has already been happening. And within that, like I said, I think the hybrid long short is, to my mind, the more versatile product, because it really gives you various combinations between equities and fixed income and other asset categories that you can do really in this category.
Wonderful. HSBC recently launched the hybrid long short, SIF. How is it different from, because you have seen about 8-9 hybrid long short SIFs which were launched last year, and have been regular features where, like what you mentioned, this is a category where there is a maximum interest, and maximum funds are getting launched in this space. So how is it different compared to the previous,
other funds,
you can say NFOs which came?
So I think, like I was mentioning, in terms of the hybrid long short category, it's a fairly versatile category, right? Because you can really do various combinations, various positioning within the equity plus fixed income space. And which is where, like you rightly pointed out, various fund houses have adopted different strategies. So what a majority of them, I think so far, have really chosen to do is really offer equity oriented products under the hybrid long short category. But of course, compared to regular mutual funds, maybe keep the volatility lower, keep the downside protection as a more important part of their positioning, and try and give more hedged strategies. But finally, a lot of them do depend on equity market sensitivities, right? And that's where majority of the action in this hybrid category has happened. When we thought about what we want to do with let's say the RedHex hybrid long short, we kind of dialed backwards to think, okay, from an investor's perspective, what are the gaps that are there? How should we look at our own product versus that gap? And one of the things that was clearly coming out is a fair amount of equity market sensitivity over the last many years has been gradually increasing for most investors, whether it's in terms of the pure equity funds, whether it's in terms of the hybrid funds, the multi-asset funds, and of course the equity-oriented hybrid long-short SIFs as well. So all of them have a common theme of equity market sensitivity, which means for whatever reason globally markets collapse or in India markets going through a rough patch, obviously a lot of these funds in varying proportions will show that impact. What we wanted to try and see is address that investor need for a product which has relatively very low sensitivity to equity market. So that was one key part that we wanted to address. Second is, of course, I think this category obviously has a very efficient taxation, right? It is 12.5% capital gains taxation if held for more than 1 year. So that's arguably one of the best taxations that is possible across various investment products, and which is why we wanted to try and make sure that after taking care of taxation, fund expenses, all that, can we generate a reasonable return from an investor's perspective? And which is where again the gap that we found in a lot of investors' portfolios is, while the pure fixed income funds with the whole marginal taxation, bring down the overall returns in the hands of the investors post-tax significantly, right, and make them somewhat less attractive for a retail or an HNI investor. We wanted to see if can we take it to what we believe is a reasonably attractive level. So that was the second part of our whole thought process of the product. So one is keep equity market sensitivity low. Second is make sure that there is a moderate amount of risk taken on the product to ensure a reasonable return for the investor. By reasonable, I mean something that beats inflation on a reasonable basis, by let's say a couple of percentage points at least over a medium term perspective. With these two in mind is where we started thinking of the product, and then we thought, okay, if you have various asset categories that are available, which ones can fit into this? And which is where what we really finally ended up doing is about 6, let's say, mini categories, if you can call it that. And if I had to go through them, I would say broadly, let's say equity arbitrage, which is non-directional equity arbitrage. Then you have basically, let's say, AAA PSU bonds, government bonds, etc. That's a second category. Third would be, AA single rated, higher yielding bonds. That would be a third category. Fourth would be securitization. Securitization is retail loan securitization, which are also called as pass-through certificates. Again, we believe a fantastic opportunity to be able to get a good, keep risks moderate, but at the same time get better returns, yields. And then, of course, the two new emerging categories, which is basically your REITs and InvITs. All of them satisfy to us both the requirements. One is keep equity market sensitivity negligible or very low. Second, they have the potential when put together to deliver potentially inflation beating returns, right? And that's where then we put together all of these things. So I would really call our RedHex hybrid long shot as a product which really needs to make sure we do our asset allocation across all these 6 categories in a measured way, in a judicious way, ensuring a combination of liquidity while still having the yielding component. So our alpha opportunities in this, for example, is that we are targeting, let's say, 11% yield on the on the bonds that we have in the AA and single A space, and in the securitization as well. The return expectations from InvITs, given the dividend distributions that happen over there, also can be fairly into double digits. And the other 50%, we want to make sure takes care of our liquidity requirements and delivers whatever 7%, 7.25% that typically arbitrage or AAA bonds usually deliver. But putting these two things together finally gives us a good package. It satisfies a blended yield which potentially can give inflation beating kind of returns, and at the same time ensures that the product, which is in an open-ended fund format, so we are mindful of liquidity related risks, and especially given all the things that have happened in our industry in the past. So that's how the whole RedHex hybrid long shot product really we thought about it. And I think now we are into our second month of the fund, and really basis various feedbacks from distributors, from clients. I do think that it somehow hits all the right spots. We're not trying to overdo on the risk return part. We're trying to take a moderate level of risk, but at the same time deliver a product which, like I said, importantly has low sensitivity to the equity markets. Right? That's really the product all about.
Wonderful. Quickly, if you could just tell what are the guardrails you have put to reduce the volatility in this fund?
Right.
What are the guardrails you have put?
Sure. I think if I had to, let's say, translate that question more into guardrails are required because of risks. What are the type of risks in this fund? I would say broadly 4 types of risks that you can broadly say. First one, because there is a fair bit of fixed income in the product itself, interest rate risk, right? Which is basically volatility that happens to the NAV if interest rates move up and down. Over here, we are really broadly targeting at a product level. I would say a 1 to 1.5 years kind of a modified duration of the fund, which is like a typically a low duration fund or a short duration fund. So the whole idea is not to take aggressive duration calls of 10-year, 30-year government bond. No, we are sticking to 1 to 3 year kind of broad investments, I would say, keeping the overall interest rate duration at about 1 year, so that the impact that comes from interest rate going up and down is relatively less. So that's one important guardrail that we have to take care of interest rate risk. The second risk is in terms of credit risk, right? Because like I said, we do want to take a moderate amount of risk to make sure that we deliver a reasonable yield and a return to the investors. So over there is where, like I said, we are looking at about, I would say, 40% of the portfolio, total portfolio, to be invested, I would say, in non-AAA papers, broadly in the AA and single A space. Target for us, broadly in a yield range of 10.5 to 11.5% is what we are looking at for this segment. And to over there, the guardrail is to ensure that issuer level diversification, for example, or issuer concentration, we gradually bring it down closer to that 3% per issuer or lower. So that's what we want to target it out. Second is, like I said, important part within credit risk itself, we are very clear about our guardrails in terms of what kind of risk return we want to deliver in this product, right? Which is where we really don't want to push on the credit risk element too much to be able to deliver outstanding returns. No, it's a product which is meant for a measured investor who's okay with a moderate amount of risk, and the returns will also be commensurate. So that's the second part from a credit risk perspective, keeping it in check, having a diversified portfolio across both issuers and sectors. Third risk, I would say, is from a equity market risk, right? Because equity market is going up and down, how will it impact the NAV? Like we spoke earlier, the whole idea is to keep the equity market sensitivity relatively low. And over here, the arbitrage portion that we have is non-directional equity arbitrage, really. So it really reflects more the risk-free rates at any point in time. And of course, we have some exposure, 10%, let's say, to REITs and about 10 to 15% in InvITs. That's the component which is, I would say, hybrid instruments between fixed income and equity, which can have a little bit of volatility. Apart from that, the rest of the portfolio is all pure fixed income. So which is where the equity market sensitivity of this product, and one can see it as equity markets go up and down. Over here, for this product, you will see a much more stabler NAV pattern, simply because our equity market sensitivity is a lot lower. So that's our third guardrail from equity market risk perspective. Fourth, I would say, importantly, from a liquidity risk perspective, to ensure that it's an open-ended fund, that over time the fund delivers what it is meant to deliver. For us, it's to make sure that liquidity is handled properly. And like I said, the good part about this product is half my portfolio at any point in time is fairly liquid, which is arbitrage into AAA bonds, government bonds, etc. Right? So that gives a lot of comfort for us from a liquidity perspective over a period of time. So these are the various guardrails from a risk perspective that we think ensure that the product really over time delivers what it is meant to do.
But when you mention it's hybrid long short,
right?
So where are you going long and where are you going short?
Right. See, overall, I think from a SEBI perspective, the whole idea is to give freedom and flexibility, right? How one chooses to use it is really up to each fund house, and that's the whole point of product innovation.
Right.
This category is predominantly is in a hybrid category. If you see, if like I described earlier, the 6 asset classes that we have, it's really hybrid in its truest form, right? It is arbitrage, AAA bonds, REITs, InvITs, AA single rated bonds, and securitization. So it's across all of these asset categories, measured exposure to each of them. So it's a true hybrid. Obviously, from an arbitrage perspective, there is long and short, because you're long the underlying cash stocks and you're short the futures, equity futures. So that's what really delivers arbitrage. Obviously, we have the capability, if we so desire at some stage, to take, let's say, a short position as far as interest rates are concerned through interest rate swaps. But from a practical perspective, because we are already running a strategy having a duration of about 1.5 years, I don't foresee us using that in a meaningful way.
Right.
So coming back to your question, I think the important thing is, obviously from a regulator's perspective, the whole idea in the hybrid long short is to enable both the hybrid part of the category and the long short part. Within various fund houses, it's really up to each of us how we want to position our product. So like I said, for us, it's about hybrid across various categories, keeping equity market sensitivity relatively low, and taking a moderate amount of risk to deliver a good tax-adjusted return in the hands of the investors. That's what our final thought process is, and that's how we are.
Wonderful. So can I conveniently say that this is a very good alternative to someone who is looking at a fixed income kind of a product with tax efficiency?
Yes. The only caveat I would say is, obviously this is a hybrid fund, right? One has to be mindful that REITs, InvITs, for example, are hybrid instruments. They have very attractive dividend distributions, both at REITs as well as InvITs. That provides a lot of stability, but finally they are equity-like units. Just that they are a lot more stable than a typical equity share of a company, for example. So to that extent, REITs, InvITs are non-fixed income. They are hybrid instruments, and of course there is equity arbitrage as well. So overall, I would say yes. The whole idea is to deliver more stable returns, and to that extent, it's definitely an alternative that investors should we're looking at, given the tax efficiency of the product, the, let's say, I would say moderate level of risk that we are positioning this product at, I think it compared to locking into much more longer tenor, much more riskier investment avenues, this is an open-ended fund, very well regulated by SEBI, daily pricing by valuation agencies, so NAV transparency. Given all of those things, I think it's a fantastic option for an investor to consider.
Wonderful. One question, and I'll put it into two parts actually. Is one, what is the time horizon which investor should come and invest into this product? Right, that is one. And second is I just saw that there's a 14-day window
Yes.
to redeem. So typically in a mutual fund, in a debt fund, you get it in 1 day.
Correct.
So it's T plus 1 generally.
Yes.
But here I could see it was T plus 14 actually. So
Yeah.
could you clarify on both these aspects?
Absolutely. No, both are very, very relevant questions. First one, in terms of the time horizon from an investor's perspective, I would say broadly, unlike in the past when typically one had to look at various fund categories in terms of the tax horizon that was required. So, for example, let's say debt funds. Earlier, they used to require a 3-year minimum holding period to get taxation, etc. So, one had to force oneself to have a 3-year plus investment horizon. Over here, obviously, from a tax perspective, it's a 1-year plus investment horizon that really one is required to have, right? If you're holding it, these are long short for more than 1 year, given that they are listed units, and that's why you enjoy the 12.5% capital taxation. Second thing is, from a portfolio perspective, what should be the investment horizon? If you look at the interest rate duration risk that we are running, or the maturity that the risk that we are running, broadly, I would say it's in the 1 to 1.5 year interest rate duration, right? Okay. So again, from that perspective, there isn't a need for somebody to necessarily have a 3-year, 5-year or longer investment view when looking at this product. So putting both these things, I would say a 1 year plus investment horizon is a fairly reasonable investment horizon to have, both in terms of my portfolio positioning as well as from a tax efficiency angle. But beyond that, of course, one can choose to have 3 years, 5 years, 7 years, because so long as the product meets the objectives, I think obviously the investment horizon can be. But from a minimum horizon perspective, I would say a 1 year plus investment horizon is a reasonable one.
Absolutely. So I think this is something which, what I can understand, is differentiating compared to the earlier long shots, which are more equity oriented. This is more debt oriented, and there is no element of equities, but REITs and InvITs is something which we need to be careful.
Yes.
Because there is where the risk lies.
Absolutely.
Okay, but definitely with the regular flow of dividends which comes in,
yes,
it makes it at least a regular payout kind of an instrument.
Yes.
Right. And I think the positioning is to have a good alternative to a fixed income product with better tax efficiency. Actually, if I just sum it up in a short manner,
absolutely.
So would this be a right way approach? Actually?
Yes, it would be. And I think the whole idea exactly is that between fixed income and equity, of course, and the product is obviously a lot more, the intention is to be a lot more stable in terms of its return composition, etc. So, and that spectrum, I would say it is a lot more towards fixed income than towards equity. And the whole idea, like I said, if you look at the various 6 subcategories, our idea is to keep equity market sensitivity relatively low. So, to that extent, absolutely. Very, I couldn't have summed it better myself.
No, wonderful. Actually, the shorting part and the directional equity is something which are the 2 risk factors which have in any long short AI which are trying to give you a equity kind of return. Yes, actually.
And absolutely, and which is where it is very important for people to see the RedHex hybrid long short as a differentiated fund within the category, because a majority of the hybrid long shorts are actually funds which thrive and deliver value through equity market strategies, right? And that's their value driver. Whereas for us, in fact, it's just the opposite. It's to keep equity market sensitivity as low as we can. So definitely, I think investors need to slowly get tuned in to see the RedHex hybrid long short as a much more stable return compared to, let's say, a lot of, in terms of volatility, compared to a lot of the peers that you would have in that category.
Right. And even mutual fund products like equity savings, the hybrid equity portion, where you have directional equity.
Yes.
And second thing is the taxation is if you have 65% equity holding.
Correct.
Actually, I think in this case it's different actually.
Yes.
No, wonderful. I think we'll do a small rapid fire, to make it a little more fun, because so we quickly,
Let me also
whatever
buckle up
comes
for
to
it.
whatever comes to your mind. Okay, you don't have to think too much. Okay, what is the first thing which comes to your mind actually?
Sure.
Okay, so if you weren't managing fixed income, okay, what asset class would you choose?
I'm glad you said asset class. Otherwise, if you just say which career would it have been,
Right.
then of course, after doing my engineering, I was the L&T in the electrical switchgear group. So
Okay.
for all you know, I would have continued there. But yes, in terms of asset classes, I think I was fortunate that I was involved with emerging market fixed income from when I was in Hong Kong from 2005 to 2010. And to me, that's a very exciting asset category, and that continues to be.
Emerging
Because
market fixed
emerging market fixed income, because across Latin America, across EMEA, across Asia, across rates and FX and derivative overlays, there's a lot of alpha value drivers that are there. And to me, that's always, given my association with that space in the past and all, it's something that's always a very exciting asset category. So I would love, if not for Indian fixed income, I would love to be involved with the emerging market side.
Wonderful. I will make it a little Bollywood style. If bond yields were a Bollywood character, who would that be?
I think what comes to mind somewhere, I don't know how many of our viewers would have Andaz Apna Apna. So you are this character, crime master Gogo. आंखें निकाल के गोटियां खेलता हूँ. So I can imagine the whole him walking in front, which is basically your bond markets with a gun aimed somewhere else. But all us fixed income investors raising our hands and walking behind him, even though the gun is aimed somewhere else. So more in terms of, I think the bond vigilantes are really actually pointing their guns at the US markets and everywhere else, right? But unfortunately, the spillover effects and the interconnectedness ensure that whether it's Indian fixed income or anywhere else, we are all at the mercy of what happens with really the US markets in a way. So Crime Master Gogo would be my
So that
character.
is Shakti Kapoor.
Yes, exactly.
Wonderful. Coffee or Bloomberg terminal? First thing, what do you do in the morning?
I am time rat. So for me, coffee is the day starts with coffee. Only thing is, it's become a little bit more cappuccino than filter coffee. But yes, for me, any day coffee first thing in the morning.
I am sure that keeps you awake also, and then you can get into the.
Oh yes, absolutely.
Okay, my fourth question is, what's one market indicator you check before anything else?
Actually, for me, really, the first thing that when I at work, I like to look at is the face of one of my portfolio managers. Because that for me is a one integrated snapshot which covers, you can make out on the expressions whether is it a good day for the markets given our positioning and the way we are positioned for it, or is it going to be a horrible day? and for me that look is that determines how the day probably going to be. Of course, after that the various indicators.
So the indicator is going to be the face expression.
Oh yes.
Okay. Inflation or liquidity, which matters more today, actually? And this is in context to fixed income.
Yes. See, obviously both are fairly important, but I think at the end of the day, like they say, liquidity is the oxygen that keeps the world going, and it's like the ocean tide. When it disappears is when you realize how deep the troubles are. So I think having liquidity is always one of the most important volatility reducers. And I would say liquidity wins most of the time. So if you have enough liquidity, I think a lot of problems can get resolved.
Right.
But also the same problems become 10 times the size when suddenly liquidity is also withdrawn for whatever reason.
Okay, so liquidity is what you will choose. Okay, in the last 25 years plus of your career, okay, what one investment rule which you have never broken?
I think I've broken all of them. But one rule that I would want never to break is really acting impulsively or in a reactive manner. I wish at those times, my hands and mouth are tied up. I think different investors have different ways of reading and reacting to markets. I would generally prefer a more medium-term view, lay out our bets and wait for the situation to develop. Reacting to a news and doing anything, at least for me, most times is always a stupidest move that can happen. It's very momentum driven and all that. So I try to keep that to a bare minimum. But yes, have I broken it? Unfortunately, I have. And every time I break it, I know why did I do it? I shouldn't do it. And hopefully, I'm slowly getting to that stage where I clearly try to avoid any kind of reactionary or impulsive move just because some news came and there's some momentum happening in the markets.
So breaking the rule is a rule.
I'm slowly getting to the stage where hopefully I don't break it. But yeah, as of now it is.
Yeah. Quickly, in yes or no. Will AI replace a fixed income manager? Only yes, no.
No.
No. Great.
And in bracket, of course, it's I hope not.
Okay. Which is the biggest opportunity in the fixed income market you feel in the next 3 years? Which space? You just put it. I'll make it easy for you.
Correct.
Triple A, double A, single A, or below that,
Right.
the investment grade or the unlisted.
See, in terms of segments, I would say from more broader Indian fixed income perspective, I think over a 3 to 5 year perspective, I think slowly we are such a large bond market. I think we are so under-owned globally and so underappreciated as well. I think we are now at a cusp, especially with the recent moves that the government and the RBI have taken in terms of zeroing out all kinds of withholding tax on interest, capital gains zero. I think slowly foreign investors, despite the fact that recently we heard that Bloomberg has deferred its decision for inclusion of India into the global aggregate index, I think it's a matter of time. I think we're going to see Indian bond markets gradually become more and more. Foreigners now own only 3% of our total government bond market, for example. I think over the next 3 to 5 years, I think it should probably hit like 8 or 10% at least, if not more, which means a fair amount of offshore money really should gradually keep coming into various segments of the market. But beyond that, in terms of the various segments itself, I think on the one hand, of course, if I use my left side of the brain, I would say from an institutional portfolio perspective, AAA segments looks good and all of that. My right side, really, I would say from a retail investor's perspective, credits. I think AA, single A credits, it's really something that, it's still a fledgling market over here. It has gone through cycles. I think we're gradually seeing once again a revival over there as well with AIFs, with PMS, and now with SIFs as well, especially ones that are oriented towards that. I think that space gradually is going to come back and hopefully grow.
So, what you're trying to tell is for the investors,
Right.
The sub AAA is credit is a better space to be.
Yes, it's something definitely I think that needs to be assessed and evaluated, and that's one place that you can get a meaningful alpha.
Okay. Last question before we end. 5 years from now, what headline about Indian fixed income would you love to read?
I think retail Indian investors, their proportion in fixed income AUM, let's say assets, goes to like 60 or 70%. Unfortunately, the tax changes and have made fixed income relatively less attractive, I would say, for a lot of retail and HNI investors. And hopefully, over the next few years, we see some of that getting addressed because it does lead to suppression of our bond market development, etc. And gradually, I think fixed income should form a big chunk of retail investors' portfolios, which is the way it used to be. Tax changes kind of change that whole trajectory. I hope in 5 years' time, the headline really reads retail investors contribute 60% of the industry's assets under management.
Wonderful, and I'm sure products like SIFs can
yes.
can help out in this.
Absolutely, that's our endeavor. Yes.
Wonderful, Shriram. Thanks for taking out time. And
Thank you so
it's
much.
always a pleasure talking to you about your experiences in the last 25 years. And all the best for the new SIF.
Thank you so much. Pleasure being here. Thank you.